There is a specific date that you can pay your credit card bill that will keep you out of credit card debt and boost your credit score. You might be wondering why you have a credit balance after you've paid your balance on your due date, and which specific date you can pay your credit card bill to increase your credit score. What I'm about to show you doesn't require any special credit knowledge and doesn't involve you spending any unnecessary money. In this video, I'll talk about when you should pay your credit card bill, strategies you can use to boost your credit score, and how you can essentially borrow money forever. Now, before we get into it, don't forget to like and subscribe. Your credit score is a number that lenders, banks, and credit card companies use to get an understanding of how likely you are to repay the money that you have borrowed and will borrow. The lower your credit score, the riskier of a borrower you are and the less likely you're able to pay back that debt. If you're over the age of 18, then you most likely have some sort of credit. Whether it came from financing a car, opening up a student loan, or opening the most common credit building tool, a credit card. According to Forbes, around 191 million American adults have at least one credit card account. Half of all Americans have at least 2 credit cards, and around 13% have at least 5 cards. If you're one of them, you normally make monthly payments to your credit card company to lower or get rid of your credit card balances. And if you pay at the wrong date or accrue too much debt, your credit score goes down. If you follow the advice that I'm going to give you in this video, you can make some great improvements on your road to improving your credit score. Credit card statements are confusing documents with a bunch of different numbers, percentages, and dates. So I'm going to make this easy so that you can figure out exactly how and when to pay your credit card bill to get the best results for your credit score. Okay, let's look at your new balance. This is the amount due during the current statement period or billing cycle. Right next to that is where you'll typically find the minimum payment due. This is the amount you need to pay for this period to avoid late fees. Depending on your credit card, this number can vary widely. Some credit cards only expect you to put $40 to $90 towards your balance, while others expect you to pay the entire balance off each month. My minimum payment is $12 because I only spent $12 this month on my credit card. The next box is the payment due date. This is the date that you must make your minimum payment to avoid late fees. Remember, there is a difference between late fees and interest. Late fees happen when you miss your due date payment. Interest happens when you don't pay your balance in full for any given billing cycle. So the credit card company charges you interest on that balance. Depending on your credit score and the credit card itself, this can range anywhere between 14% to 30% APR. Now, not all credit card statements have this, but some will also show you your current credit limit. This is how much credit the lender has extended to you. They normally tell you how much you have left by taking that limit and subtracting your new balances and call it your available credit. Lastly, you'll typically see your billing cycle, which is usually 28 to 31 days, with the last day being your statement date. Remember this term. This brings me to my next big question. When should you pay your credit card? The biggest thing to remember about credit cards is not to be late for your payments, and if possible, pay your balances in full every single month before the statement due date. Credit cards are meant to be a form of passive income. You can earn points or cash back on purchases you wouldn't normally get if you bought them outright. For example, I use my Amazon credit card anytime I buy something on Amazon, and it gives me 5% cash back. I use my Amex Cash Preferred for my groceries, which gives me 6% back at US supermarkets. Now let's talk about how we can pay them to improve our credit score. As for those statements we just went over, every month a statement for each credit card is sent to the 3 major credit bureaus: TransUnion, Experian, and Equifax. Your credit score is essentially a big pie chart. 10% of the pie is new credit. 15% is the length of your credit history. 10% is your credit mix. A whopping 65% is based on your payment history and amounts owed. This last section is where you see the most impact on your score. Let me give you an example. Let's say you have a single credit card with a $5,000 limit. You decide to go on a little shopping spree one month and buy yourself a laptop, a TV, and my $47 community of courses where I show you everything from how to buy a home to the right way to repair your credit. Now, this all adds up to about $2,500. If you wait until your credit card bill comes through the mail, this information about what you have spent has already been sent to the credit bureaus. They will see your credit utilization as 50% for that month. This increases your risk to lenders which has a negative effect on your score. You can offset this negative reporting by making an early payment on your credit card. This means that you'll show a much lower balance when your statement is sent to the credit bureaus. So if you spend $2,500 of your $5,000 credit limit, but make an early payment of $2,000 before your statement date, the credit bureaus will only see your credit utilization as $500 or 10%. That way, when the bill does come, simply pay off the $500 plus interest for that statement period, and the next month, your credit utilization will be 0% if you don't use your card. This shows three things. You're using the credit that's available to you, you're keeping your utilization low, and you're paying off your balances in full. These factors will positively affect your credit score. It shows that you bought the stuff that you wanted, earned the points, and paid it back responsibly. Now, if you want to know when to pay your credit card to not have a balance left over, you have to follow this advice. If you have just made a payment to your credit card and paid it off on the due date, what you want to do is try not to use your credit card during the gap between your due date and the statement date. If you do, you want to be sure to pay any balances that you've accrued during the stretch before your statement date, so that no balance gets reported to your credit report, which will boost your score. Now, I was going to gatekeep this, but I'll give this to you for free. Now, you've probably gotten hundreds of letters over the years of credit cards looking to sign you up. Most of the time, these cards will advertise a 0% introductory rate. So I want to talk a little bit about what this means, how it can help or hurt you. Most introductory 0% APR cards will allow you to hold the balance for up to 12 to 18 months without bearing interest. That's how some people are able to use credit cards to purchase things like real estate, finance vacations, or even weddings. Depending on the credit card you have, you might just be able to pay the minimum payment every month, which could be as low as $25. Then what you could do is a method called credit stacking. This is where you can use multiple 0% APR offers to transfer the balance onto one another after the 0% interest period is over on the previous card. So that way you can borrow money without interest for years. Just know that this will affect your credit utilization and can still lower your score if you borrow too much. So if you're planning on maxing out your cards and still trying to go to finance a car or a house, your utilization might be too high, which will lower your score to be able to get those things. Let me give you an example of credit stacking. If you have two credit cards with $10,000 credit limits, one is 0% APR and has a $9,000 balance. The other is a standard card and has a $2,000 balance. Your credit utilization is $11,000 or 55% of your total limit. So even if you're not paying interest on that larger balance, it is still negatively affecting your credit score by contributing to your credit utilization. So don't just assume that you can hold these big balances forever. You need to be actively working to reduce them to keep your credit score from dropping. This last strategy is easy. If you have multiple credit cards, it can be difficult dealing with different billing cycles and easy to confuse the dates for your cards. If you want to make everything simple and still boost your credit score, you should start using the auto payment feature as soon as possible. Almost every single credit card company has this, and you usually get two options. Make the minimum payment every time your balance is due, or pay the balance in full when your new balance is due. I recommend that you set your payment for around 4 to 5 days before the due date and have it cover the full balance. This way, you'll never be late. At the end of the day, you do want the credit bureaus to see that you're using your credit. So it's okay to go back and forth between leaving a 5 to 10% balance some months and other months paying it off completely. Whatever you do, you just don't want your utilization to be over 30% because this will affect your credit negatively. So if you do choose to use auto payment, don't set it too early and still use your card. See you in the next one.